Okay, let's unpack this. Today we're diving deep into the Q1 FY26 financial results for Aarti Drugs Ltd. We've got the official filings, BSE, NSE, the financials, auditor reports, and the company's own investor release. So, quite a bit to go through.
Yeah, absolutely. And what's fascinating here, I think, is our goal isn't just reading numbers. It's really about pulling out the key insights, right?
Mhm.
Understanding the so what behind it all and seeing how Artie Drugs is positioning itself in, well, it's a pretty dynamic industry.
Okay, so let's get straight into it. The Q1 FY26 snapshot, the big numbers first. Consolidated revenue hit nearly 591 crores,
Yep.
590.8 crores to be exact. That's a decent 6% jump year over year compared to Q1 last year.
All right, 6% up from our RAS, 556.5 crores in Q1 FY25.
But here's where it gets interesting. It was actually down 13% from the last quarter, Q4 FY25.
That Q-O-Q decline, down from about 679 crores. So you see this mix, right? Year-over-year growth, but a sequential dip. That often points to maybe some seasonality or specific market conditions playing out in that quarter.
Makes sense, but what about the profit?
Well, that's the really standout figure here. Profit after tax, the PAT, it surged, a substantial 62% jump year over year. Came in at Rs 54 crores.
62%. Wow, that's quite a leap from Artist 33.3 crores last year.
It is, and look at the PAT margin too. It climbed 310 basis points.
So 3.1 percentage points.
Exactly, from 6.0% up to 9.1%.
Yeah.
So even with that quarterly revenue dip we mentioned, their profitability just shot up. It suggests they're getting much more efficient.
Right, squeezing more profit out of the revenue they are making. What about EBITDA?
EBITDA followed a similar trend, up 12% year over year to Rs 74.4 crores. And the EBITDA margin also improved by about 70 basis points to 12.6%.
Okay. And earnings per share.
EPS reflects that strong PAT growth. Came in at Rs 5.91 for the quarter compared to Rs 3.62 in Q1 last year.
So efficiency seems key. You mentioned that. Did we see it in gross margins too?
We did, yeah. Gross profit margins improved by 130 basis points. They reached 36.8%. And like you said, that really points towards better cost management, maybe some improved pricing power as well. They seem to be managing their inputs effectively.
And just quickly, the standalone business, that's the core, right?
It is. It brought in our 521.3 crores, also showing that 6% year-over-year growth. And it makes up, the lion's share about 86% of the total consolidated revenue. So the core Indian business is performing steadily year on year.
Got it. So solid overall performance, particularly on the profit side. Let's dig into the segments now. What's driving this? You mentioned API is their core. How did that perform?
Right. API, active pharmaceutical ingredients, that's their biggest segment. Revenue was our 458.2 crores. It showed a 4% increase year over year. The CFO's commentary kind of backs this up, pointing to improved demand driving recovery and volume growth there.
Okay, 4% for API. What about the other areas?
That's where we saw some stronger growth figures, actually. Formulations revenue was ours 80.3 crores, but that was up a significant 14%.
14%, okay.
And specialty chemicals, though smaller at ours 23.1 crores, led the pack with 24% growth.
Wow.
And even intermediaries and others, about ours 19 crores, that was up 22%. So growth across all segments, but particularly strong outside the main API business this quarter.
Interesting mix. And where are these sales happening? Domestic versus export?
Good question. Looking at the standalone business again, the split is about 65% domestic market. That part was actually flat compared to last year.
Flat domestic, all right.
But exports really picked up the slack. They grew by 18% year over year. Exports now make up the remaining 35% of that standalone revenue.
So international sales are driving the growth.
It seems that way, particularly for certain segments. Get this, over half, 57% of the revenue from that growing formulation segment actually came from exports.
Ah, okay. So that 14% formulations growth is heavily export driven.
Seems like it. And just digging into the API business a bit more therapeutically, antibiotics are still the biggest chunk, around 41% of API revenue.
41%, okay.
Then you've got antiprotozoal at about 19%, anti-diabetic around 15%, anti-inflammatory at 12%, antifungal near 10%, and then others making up the rest.
That heavy reliance on antibiotics, 41%.
Yeah, it does raise an important question, doesn't it? For you listening, how might a product mix like that, with one category being so dominant, influence their overall market resilience? Right. Their ability to adapt if demand shifts or new treatments emerge.
That's a really good point, resilience and adaptability. Which leads us nicely into their strategy, their investments for the future. They spent about, what, Arnhem Servant 48.5 crores on CapEx in Q1?
That's right, around 48.5 crores.
And the focus was capacity expansion, backward integration, and R&D and formulation.
Exactly, and they're planning to spend quite a bit more through the whole year. The projection for FY26 is between 150 and 200 crores in CapEx.
This is a serious investment. What are they building with that?
Well, a big piece is these new greenfield manufacturing sites. Take the one in Sayaka, Gujarat. Trial productions have already started there. And its main purpose is strategic. Backward integration.
Backward integration, meaning making their own raw materials.
Precisely. Instead of buying everything, they'll make key inputs themselves. For Sayaka, it's about inputs for their anti-diabetic products, things like choline chloride. The idea is, serve their own needs first, reduce reliance on outside suppliers, hopefully stabilize input costs, and ultimately boost their profit margins over time. It's a long-term play for resilience.
Makes sense. Control your inputs, control your costs. What about the other major project, the Terrapur plant?
Right, the salicylic acid plant at Terrapur. That's also progressing well. They expect it to start contributing to the financials from Q3 onwards.
So, soon then?
Yeah. They apparently had some initial startup hiccups, which isn't uncommon when you develop tech in-house, but they say those are sorted now. The big focus there is ramping up production, aiming for over 800 tons a month, and then expanding the total capacity to maybe 1,600 tons a month by the end of this fiscal year.
That's a huge ramp up. Are customers interested?
Seems so. They mentioned new audits by regulated market customers have already been triggered at Terrapur.
Yeah.
That's a positive sign. And they're planning further expansion there, too.
Now, let's connect this to the bigger picture. We've seen recent news, like the U.S. government putting high tariffs on pharma products and APIs from China.
Mm-hmm.
The aim is clearly to reduce that dependency on China. How does that impact a company like Aarti Drugs?
Oh, it's potentially a massive opportunity, a really significant shift in the global supply chain. When a major buyer like the U.S. tries to diversify away from China, it creates this vacuum, this demand that needs to be filled.
And Indian manufacturers could step in.
Exactly. Especially companies like Aarti Drugs that already have the credentials, like existing U.S. FDA-approved facilities. Plus, they're actively commissioning all this new capacity we just talked about, Sayaka, Terrapur. They're basically building the infrastructure to capture that potential shift in demand.
So the timing looks pretty good for them.
It does. And it's not just API. Remember their formulation subsidiary, Pinnacle Life Science.
Right, you mentioned them earlier.
They recently got U.S. FDA approval for their oncology facility and also UK MHRA approval for their OSD oral solid dosage facility.
More regulatory green lights.
Yes. And the plan is to leverage those approvals, develop and register new oncology products globally. They're aiming for growth in regulated markets starting around FY27.
So it really seems like a long-term strategic vision aligning with these big global trends.
That's what's fascinating, I think. You see how their investments in capacity and backward integration and regulatory approvals, it all ties into these global supply chain shifts and regulatory dynamics. They seem to be anticipating where the puck is going, so to speak, and building for it.
Okay, before we wrap up, let's briefly touch on the corporate governance side. The board met on July 18th, had quite a long meeting over 4 hours, and one outcome was appointing new secretarial auditors, Mrs. Mehta and Mehta, for a 5-year term, pending shareholder approval, of course.
Right. Appointing a firm like Mehta and Mehta, who've got, over 25 years of experience in this, it signals a focus on strong compliance and transparency. It's good governance hygiene.
And they have specific secretarial audit experience.
Yeah, the notes say they have a dedicated team for it, experience across different industries. It's a standard but important appointment for a company this size.
And the main financial audit.
That was done by Gokhale and Sath, chartered accountants. The report did mention, as is common, that the consolidated results included financials from a foreign subsidiary, that Gokhale and Sath didn't audit themselves, but were reviewed by other auditors.
Right.
It just underscores, the complexity and the multiple layers of review involved in reporting for these large international companies.
Absolutely. Okay, so let's try and summarize this for you, our listener. What does this all mean? Well, Aarti Drugs' Q1 FY26 showed, I think it's fair to say, really robust profit growth.
Definitely on the profit side.
Yeah. And it seems supported by these strategic investments they're making, expanding capacity, deepening that backward integration. They seem to be making some calculated moves to really position themselves to benefit from these shifts in global supply chains and grab opportunities in regulated markets. It feels like a company with a clear long-term plan.
I agree. And maybe this leaves you with a question to ponder. As we see Indian pharmaceutical companies like Aarti Drugs making these strategic bets, investing heavily in advanced manufacturing, R&D, global regulatory compliance, how might this long-term approach change things?
Yeah.
How could it redefine not just their own competitive edge, but maybe the whole landscape of global pharma and specialty chemical supply chains in the years ahead? Something to think about.
Indeed. A lot to consider there. Thank you for diving deep with us today.